Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Savita joins us now. Savita, good morning to you.
Good morning.
Which one is this? Stagflation, hard landing, no landing? Where are we going?
I think we're going to a soft landing with a reasonable market environment, maybe better growth ahead than what we're used to, higher rates, a little bit higher inflation. But look where we are on inflation. These are the levels that we all used to write about as the Goldilocks levels, right? We're not at 9, we're not at 0. We're around 3 or 4. Those are healthy levels for equities.
It doesn't sound late cycle when you speak. Where are we in this cycle?
Who knows? I mean, I think this cycle is very asynchronous, if you will. So it's, there's some areas that are booming. We're still kind of coming off of COVID. So we've got services demand maybe slowing or tapering off, goods demand potentially picking up. We've got still tight employment. But then there's also a couple of structural factors that I think are skewing the cycle call. So we have a very tight employment market. And one of the reasons for that is demographics, which we're in an aging demographic scenario. And then on top of that, we had a huge number of early retirees during COVID. Unless we loosen immigration, I think that we're going to remain in this very tight labor market. So that's the other factor. And, we've talked about this. I think the consumer is in a very different balance sheet setup than in prior cycles where, long-term fixed rate mortgages, 85%, very different from prior cycles. You've got baby boomers sitting on wads of cash. So I just think that this cycle, you can't just map on the typical, the Fed is tightening. It's, we're late cycle. Now the Fed has stopped and they're going to start cutting. We're early. It's a different type of market.
You used the G word. Sorry, I apologize in advance. It's been a long week. Goldilocks. And we heard this from Max Kettner too. And this really raises the question, can we have Goldilocks with 5% Fed funds rates? Is this actually just a new rate? Is it not actually restrictive? And is it something that can actually even allow a broadening out and a rally, even without any rate cuts this year?
I think so. I mean, I think there's a very high probability that the Fed remains on hold. Our economists have talked about this as well. So we expect a cut in December, maybe no cuts. Look, I think 5% is a manageable number, especially if you have corporations that have locked in fixed rate, long-term debt. You've got, and this is the S&P, not necessarily small caps or other regions, but I think that the S&P has actually prepared for this moment. Now you've got big tech companies, the go-go growth stocks, initiating dividends, right? We've got an environment where the market is adapting to higher interest rates, shortening their duration, giving us more cash. I think this is actually a kind of a reasonable setup for equities here.
I don't want to be cynical. There is this concern with people focusing on large caps that can handle this. Mm-hmm. The people shrug off the highest delinquency rates going back many years. This idea that if a number of people just get blown out, fine. No, it's okay. We can just go into luxury. We'll go into big tech. We'll go into the areas that'll do fine, and we'll be fine, even if other segments are getting kind of blown out. Right. How long can that go on?
I think that is a key risk. And I mean, we've seen that income gap widen for decades now, right? I think what's happening now is actually potentially better for the middle to lower income customer if you're in certain sectors. So look at manufacturing in the U.S. There's still a very tight labor force. Real wage growth is positive. Where you're seeing a lot of the layoffs is more in white collar, not necessarily middle America, where you're seeing still very strong signs of this reshoring boom that has a long tail, right? I mean, you can't build a factory in a year. This reshoring theme is a very long-term theme that I think has legs over the next several years. And that's where the job tightness is. That's where the real wage growth is really positive. And I think those are areas that are, different from where we've seen benefits in the past. So that's one way to stave it off. And then, I think higher oil prices are also a concern if you think about geopolitical risks. But where we are today is I think the U.S. is in a better position because we are now a net exporter rather than an importer. So we've got a little bit more wiggle room around oil than we did in prior cycles. But you're right, it's a concern.
Well, when it comes to these low-wage workers, you say maybe they're getting jobs in manufacturing, but I go back to what Diane Swank said yesterday to Jonathan, Lisa, and Tom. These individuals move from the shadows of the economy into the sun. Maybe that's the labor market that's getting a better job, but then they get hit by inflation. They get burned by inflation.
Right.
So how does the Fed think of these individuals when it comes to higher inflation? Because we know they have no appetite for a hike.
Right. So I think that where we are now is an environment where we really do need to see some of these inflationary forces subside. And where I think there's a couple of things going on that could actually continue to create a ceiling on inflation. So think about it. There's still demographics, and demographics. We've got aging population, less demand for stuff. That's sort of a disinflationary pressure. You've also got disruption from AI, tech, automation. So that's a continued disinflationary pressure. I don't see inflation going to the 70s levels. That's really untenable for your average consumer. I think there's enough of a secular disinflationary force at play that we've all been talking about, for the last 20 years that can actually stave off a really aggressive level of inflation. And then on top of that, I think the energy independence of the U.S. is a really important factor because, that's a benefit to the U.S. that most other developed economies don't have. And I think that's something we should be happy about.
Let's finish on something you've been focused on for quite a while, old economy value. Energy, industrial, starved of capital. I remember you outlining this, I think maybe 12 months ago. Still a big theme for you and the team.
Yeah, and it's worked for maybe 2 months out of the last 12. But, I think where we are now,
I wasn't throwing mud, just for the record. I was genuinely interested in the thesis.
Well, again, I think we're in an environment where the broadening of the market is still a theme we talk about. And it's started to happen in the last couple of months. Look, who's going to benefit from all these chips and this AI and, automation? It's old economy companies that get more labor light. And I think that's the benefit that we could see over the next, 12 to 24 to, few years. I think the areas are, industries like ours, the banks, right? I mean, banks are very labor intensive. Now there is this tool that we can use to replace people with bots and processes, et cetera. So I think, it's a potential streamlining or cost-cutting story, self-help for a lot of these old economy services sectors that haven't really addressed their labor intensity for quite a while.
Savita, this was awesome. It's good to see you. Andrew Hollenhorst of Citi offers us one. We maintain our base case for 100 basis points of cuts in 24, substantially more than priced by interest rate markets. Andrew's with us around a table. Andrew, hello. Let's go straight to it. 4 cuts in 24. This is not consensus. Where does it come from?
Well, the Fed's going to cut this year. I think that was very clear from Chair Powell yesterday that at least the next move is a cut. And the way that they get there is because the inflation data is going to give them the opportunity. I don't think it's going to 2%, but it's going to be slow enough that it lets them cut. And then the labor market is going to weaken. And we heard that from Chair Powell, this idea that we're seeing that the trend is really towards a weaker labor market here.
I think this is your signature call for this year. It's the weakness that you're anticipating in the labor market. Do you see it now? Where's it coming from?
This is really important because what we heard from Chair Powell is with the 2 mandates, the dual mandates in better balance in their words. So inflation has come down. It's not at 2%, but it's come down. They're looking at employment now. And when you look at employment, Chair Powell highlighted some of these things. You look at the conference board. Do people see jobs plentiful or do people see jobs hard to get? They're seeing jobs as harder to get. You ask people, are you more worried about keeping your job? They are more worried. We see that in the New York Fed survey. And then you go to the NFIB small business survey. It's going to come out today at 1 p.m. Let's see where it is. But you're seeing small businesses that are saying they're not excited about hiring. So all of these indicators are going in one direction.
At the same time, we've been seeing signs of cracks for a really long time. People expected things to weaken substantially earlier this year. They haven't. Late last year, they didn't. So at what point do you have conviction this time is different?
So I think a lot of those calls were maybe not wrong, but just very premature, and the cycle has just extended a lot longer than many people thought. And what we were going through in the labor market was a kind of normalization. We had job openings that were extremely elevated. We had just incredible need to hire people and restaff. And we've really worked through a lot of that now. When we look at these trends, take the quit rate in yesterday's JOLTS report. That's at a decade low. And what that's telling us is that this isn't just normalization at this point. This is people that, at least in the last 10 years, people have not been this worried about holding on to a job.
Which really raises an interesting question about tomorrow's non-farm payrolls report. We're talking about how high numbers will be and how high numbers have been, and it really is one of the reasons why people say this is a robust labor market. Are you saying that those numbers inaccurately represent the true labor market and are distorted by immigration, by other types of features that really might mask a real level of weakness that could catch us to us sooner than many people think?
I think that's right. And one of the great things about being a U.S. economist is we have an incredible range of data to draw on, especially with something like the labor market. So the biggest focus is usually, right, that establishment survey, non-farm payrolls. Those have been strong. If you look at almost any other labor market indicator, they range from slightly weaker than that to a lot weaker than that. Take the household survey. That's where the unemployment rate comes from. The unemployment rate has been moving up because employment in the household survey has been softer. Take the business employment dynamics survey. Now, this is something most people don't watch. It comes out very, very lagged. The numbers just came out from Q3. 9 million firms that are accounted for in this. This is really the official data on what firms were doing in Q3. If you look at that data, we lost jobs in the third quarter. I'm not saying that actually happened, but you look at all these different data points, you kind of plot them all together and try to figure out where the trend is. That trend is towards a weaker job market.
Let's take a look at the hard landing versus soft landing chart. We'll do that together. I'll do it in the air for you. It's been a long night, okay? So soft landing here, all right? Hard landing over here. Soft landing, immaculate disinflation, big supply side recovery, et cetera, sounds like you're somewhere over here. Is that fair? You're looking for something close to a hard landing this year?
That's fair, and I think that markets have actually moved away from this soft landing idea. It's pretty clear from the inflation data that we're not getting the soft landing. If activity holds up, then maybe we're going to have more of an issue with inflation. The reason I think that the Fed's going to see enough to cut is because, that's right, we're more towards that hard landing end of the spectrum.
So when you look at market pricing, and this has echoes of a conversation we had with Gershon Distenfeld of AllianceBernstein in the last week, do you see the pricing of, say, one rate cut this year as just a weighted average of a whole range of possibilities and maybe not the most likely outcome?
That's right. Markets are always going to average over all the possibilities. And you heard Chair Powell, it was kind of this multiverse of possible Fed outcomes yesterday. They could not cut at all. They could be cutting. I think what's important is the asymmetry of the Fed's reaction function. You don't need both softer inflation and a weaker labor market. You just need one or the other, and that's why they're going to cut.
It's fascinating to me that you said we're not getting a soft landing. You expect 100 basis points of Fed rate cuts. Is that basically you saying that you think the damage will be done enough that even 100 basis points of rate cuts won't be able to give that sort of surge of stimulus into the economy soon enough to stave off a real downturn?
This is what happens in almost every monetary policy cycle, and I don't think that there's good reason to think that this cycle is going to be different. We have inflation that's run higher than expected, still higher than expected even in the first quarter. That has kept policy rates higher for longer. We're in the higher for longer stage of the policy cycle. The next stage of the policy cycle is a weakening of the labor market. Once it starts gradually weakening, it then weakens more sharply. I think that's exactly what's playing out now.
Just quickly, how united is that committee on the FOMC?
I think there are a lot of different views around the table right now, and I think Powell is probably something of a master in terms of somehow bringing things enough together to do that press conference yesterday.
Andrew Hollenhorst of Citi. Stephane, wonderful to catch up with you, sir. The stock is just about positive in the pre-market. Can you talk to me about how you're balancing cost-cutting with investing in innovation, given what's in the pipeline?
Sure. Well, good morning. Thank you for having me. So very pleased with the quarter. We basically try to focus on how do we drive sales, how do we drive R&D, and how do we prioritize opportunities, which is why, for example, we announced that we are stopping the partnership with Metagenomi in research in gene editing. Same thing, if you look at the portfolio, we're looking very carefully at all investments. And the good thing about those vaccines like respiratory vaccines is you only pay the phase 3 study once. So if you think about COVID, we still have sales from COVID, but the investment in R&D of COVID has come down a lot. As you said, RSV, we are anticipating a launch this spring, but we're not going to do another phase 3 for RSV. So you can still basically have a lot of new studies going on, reusing the capital you used to put in the other products before. And then if you look at oncology, as you know, we're in a 50-50 profit share with Merck. So Merck is paying half of a phase 3 study. So that's how we're managing. We're investing a lot in technology. You might have seen last week an announcement with OpenAI. We have actually more than 750 GPTs going, and that is helping us a lot scale the company across not only science, but also driving a lot of productivity in manufacturing, in commercial, in legal. So that's kind of how we're doing it.
So, Stephane, let's talk about something that our colleagues here at Bloomberg are extremely focused on, and that's your RSV shot, which, according to our colleagues, some data is showing that maybe it doesn't last as long as others in the market. What we all want to know here at Bloomberg is whether that raises questions about the promise of your technology in treating other diseases. How would you answer that?
So I would first say that if you look at the data, the duration of the other vaccines, they are very similar. So I don't think it is scientifically correct to say that one of the vaccine doesn't last as long as the other ones. Of the two that are approved and ours, if you look at the data. This will be debated at the CDC meeting at the end of June for recommendations. So this doesn't worry me. If you look at duration, the duration of vaccination is induced by T cell. If you look at our cancer product, the only reason it works is T cells, not antibodies. Antibodies don't have a role in cancer. It's about T cells going and attacking your cancer. If our vaccine technology didn't have good T cell response, the cancer product will not look as good as it is. So I'm not worried at all about duration.
Pretty much every time we speak, Stephane, I ask you, basically, have we cured cancer yet? So I'm glad that you went there, because that's been sort of one of the big questions and the hope for a lot of the mRNA vaccines. You have this melanoma vaccine in the works. What more do you have to do to get it sort of set up for the approval process to apply for that? And are you using artificial intelligence to expedite that?
Great question. So if you look at cancer treatment in melanoma, we've said that we need to achieve three things to be able to talk to the regulator about an accelerated approval. So the phase 2 data is the data we shared on the show several times. We're seeing duration. If you remember, in December, we shared the 3-year survival. It was better than the 2-year survival. So the difference between people on our treatment and people that are just getting Keytruda is getting wider. So there's a very strong evidence that the drug is working. So that's number one. Number two is we need the phase 3 study to be substantially enrolled. And so we are working very actively. The phase 3 study started 2 months earlier than planned last summer. And so when we are substantially enrolled, we will meet that criteria, and it could be later this year. And the third one is the plant, because of course we need to file in the registration dossier all the information about the manufacturing process. The FDA, the day you file, is allowed to go, of course, audit your plant. That plant is being built. I had the chance to go there 2 weeks ago. The team is working non-stop, scheduling literally by the days, a bit like we did during COVID, during the pandemic. And so I anticipate that potentially sometime next year, if a regulator was willing to look at the accelerated approval file, we should have this product available to help a lot of people, because 1 in 2 people benefit with no disease coming back or no deaths, compared to the best drug available today to them on the market.
Stephane, could you just give us a sense of, you talk about artificial intelligence. Everyone's talking about artificial intelligence. Could you just talk about how much that could expedite generally some of the drug production that we're seeing, just how much that could really get us to achieve, that cure for cancer, that cure for ALS, that cure for Alzheimer's? It's funny, you're talking about Sex and the City. I sit around and I worry about these things. When are we going to cure these things? So I'm just wondering, is this going to be in our lifetime in the next couple of years because of some of the machine learning?
Yes, so I think there's a few things to tear apart in your great question. First is, I think machine learning in academic labs, in research labs, in industry, is helping accelerate the understanding of a human body. If you think about, diseases like Alzheimer and other complicated diseases that we do not have solutions for yet as a society, it's because we do not understand the biology. We do not understand how the disease happened, how the disease evolved. And so we are just trying things, and some work, but very few work. Most of them don't work because we're just trying and guessing. If you look at biology, once we understand how something works, then the industry can come with very, very good actions to deal with those. So I think AI will accelerate the understanding of biology, which will be fundamental to bring new drugs. Then AI is already used to accelerate discovery in terms of what tool do you go after a disease once you understand it. At Moderna already, we have different chemical matters that are generated by our AI system that are helping us to accelerate the work that humans are doing. So it's an accelerator to the teams. And then there's a huge chapter on productivity. If you think about clinical development, phase 1, 2, and 3, it's basically doing experiment in human, getting the data, finding the dose, doing more experiment, and when you have all the study done, you gather all the data and you submit by the regulator. My point, it's all about data. There are literally hundreds of business processes that need to happen. And I think many of those, if not most of those, you're going to be able to apply AI to shrink time, to go faster. An example we shared in March in our vaccine day. The team wrote a GPT to help us to do dose selection. When you do a clinical study, your phase 1, you try several doses. And then based on the data you get in the clinic, you decide which dose go into your phase 3. Well, it used to take around a month to do that by having people and meeting and experts looking at the data. Well, we developed a GPT that basically gets all the data from the clinical study and suggests to us a dose in literally a minute or two. That is already a tool that has been developed that I've seen used at the company. That's just one example. So here you go, you shrink a month. And if you do that on the hundreds of business processes that have to happen in preparing the drug for the clinic, the clinical testing, the analyzing of the data, the communication with the FDA, I think you can save a lot of time. I don't know yet, because only history will show us in the next few years. Can you shave 30%, 40%, 50% of how many years it takes you to develop a drug? I think it's going to be very significant.
Stephane, we've got to leave it there. It's fantastic to catch up with you, sir. Amazing to listen to you talk about the efforts taking place at Moderna. Moderna CEO Stephane Bancel.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.